Welcome, everyone. Good afternoon. Welcome to 25 Minutes with Cap. Today, we're going to talk about the specialty insurance marketplace, including rising rates, broker consolidation, returning to work. And to join me here, I've got Jack Sennott, CapSpecialty's Chairman, CEO, and President, to discuss these topics and a few more. Jack, thanks for joining.
Thanks for letting me finally make the cut and get on one of these.
Yeah, well, it's been a very selective process.
I saw.
So, as we go on from here, if you have any questions, please put them in the bottom right-hand corner. You see the Q&A button there. We'll look to address them as they come up, or at the end, or if not, we'll come back to you individually. Before we get going, just a reminder. The content of this webinar is the property of CapSpecialty and is for informational purposes only. You're not permitted to republish, share, or quote from this webinar without the prior written consent of CapSpecialty, which can be obtained by contacting marketing@capspecialty.com. All right, so Jack, let's get into it.
Sure.
You talked about what a nice day it is. It's a sunny day in June.
Yeah.
Infection rates are down.
Yeah.
Masks are coming off. Feels like it's starting to be time to think about getting back to the office. So,
yeah, well, you and I are both doing this from respective offices, which is nice, and I certainly agree with all of that sentiment. There's a lot of factors in it. I've said this before on the office. It was in some ways, although it didn't feel like at the time, easier to just send everybody home. It's in bringing people back that there's the complexity of it. I think after 15 months, the muscle memory of being able to take a break and walk your dog at 10:30 or teach fifth grade math right before lunch is grown on a lot of people, and I get it. And I think people who are advocates of being at home for a long time are quick to point out, rightly so, that there's been a really strong productivity during the pandemic time. I think the struggle is that if you knew that when you sent everybody home, that everybody knew the company culture, that they were in the job they wanted to be in for the foreseeable future, and that there wasn't any development requirements, you probably could say, oh, we can make this work permanently where everybody's at home and just make a virtual company. But, ultimately we sell a promise, and that's about contracts, understanding, and service between people. And the way we do that is we have really strong connectivity between distribution, underwriting, claims, actuarial, the business folks, compliance. We've got to get people together to do that. So the challenge is going to be getting people back where they get some optionality, which is, I know, in high value now, and at the same time we build a better organization. So that'll be the challenge as we go forward here.
And certainly when you look at some of these bigger metropolitan areas, whether it's New York, Southern California, you can't argue with how convenient it is.
Sure.
To not take that hour and a half, 2-hour commute one way at times. So even if you are one of these quote unquote good employees, people who are within the fabric of the culture, is it best for someone's career to be able to take those obvious trade-offs?
Yeah, no, it's a fair question, and I don't think there's a single answer to what someone's best interests are. I think it depends on what position they're in, what department or function that they serve, and kind of where they are in the learning and career cycle. But I do think an organization works best when it's got a strong interconnectivity amongst its employee base, and despite the fact that this is great technology, which, by the way, existed since Skype for over a decade and was grossly underutilized by the insurance industry and us, certainly in that group. And I think we'll use this forever now. I do think the in-person, face-to-face is helpful. And when you're in a business that's service related and people related, really getting to know the people, it undoubtedly slips into how you think about their ability to succeed at the next level, right? So if you're thinking about career as upward mobility or, promotion or new opportunity set, I do think there is something to be said with, proximity.
So either side that you sit on here, you can't argue that certain costs have been saved throughout the last almost year and a half.
No doubt. And some of them will be forever, right?
Well, right. And so looking forward, what are the current views on the costs of running an insurance company? Is it now, is it going to be more efficient? Are you going to see that those costs that might have before been spent on marketing are just going to go somewhere else? And where?
Yeah, as I think about it, I think business travel will be changed structurally. That doesn't mean there won't be. The same thing I just said about people will matter in customer relationships as well. But I use our technology initiatives that we've got going on here. I think we're able to do that much more efficiently and effectively with this video conferencing capability than I think we would have just assumed we could have, and we would have had more people on airplanes flying back and forth. But I do think there'll be some permanent structural change in business travel. There'll also be a desire for people to get back out in that regard. And undoubtedly there'll be some areas where people can effectively work remotely. I think that should over time save some money on space. Ironically, I think it will raise costs to begin with because leases are usually long-term, and now we got to get 2 sets of double monitors and technology and right bandwidth, et cetera. But that's okay. I think the real difference here, though, is you have to remember that the overhang, even though we're a specialty business and very niche underwriting focused, the overhang of the insurance industry has a commoditization factor to it. And things that become widespread savings, really ubiquitous across the industry, tend to get adjusted for in price over time.
Sure.
It's where you can differentiate from your customer or your competitor that you can drive improved results over time. So that'll be the struggle, right?
Yeah, I think, when you look at the marketing side, I think the marketing is going to probably be a little smarter. We're probably not going to see, as much of, hey, I need to be in Dallas. Well, why? Well, I haven't been there in 5 months. I think it's going to be a lot more targeted. I think it's going to be more than just kind of having road warriors.
I think that's right.
Yeah.
You're right. That road warrior mentality probably, particularly now coming out of the pandemic, feels dated.
Right. At the very least, do you want to get on an airplane and put on a mask?
Right.
So getting back to the market, for well over a year now, rates have been rising in the specialty space. The headlines have been around larger price swings in D&O and excess casualty.
Yeah.
Do you think these businesses were the only ones that needed that much more rate? Are we going to see these trends extend to other areas, and where? Right.
Well, I think it's a well-used phrase, but rate increases are generally a lagging indicator for loss increases, whether it's severity loss costs or loss cost inflation or frequency increase, or some combination of all the case. So it's not an altruism that drove these rates up. It was experience. And you see that both on the property side, where we've had a significant increase in the number of not only meaningful cat events, but also convective storms in the spread, and then non-modeled events. On the casualty side, I think loss cost inflation is a real trend that we've seen, that we've had to deal with here. And then we have this pandemic where the economy just went from drive to neutral and then almost reverse, and is now just coming back in. So that certainly disrupted what the loss cost trends would look like. It remains to be seen now, as we have some inflation worries, how that works its way through the loss costs of our industry. And that's going to be what drives the ultimate pricing increase across the specialty space. We've had some new competitors come in, and they will certainly pound their chest around lack of legacy balance sheets. I don't think this is a legacy balance sheet problem. It's about good underwriting management, good risk selection. I think there was a meaningful effort in pulling back limits offered on any individual risk, and how well that holds will depend on how the market shakes out.
Do you see the new competitors being any type of a headwind for the market getting better price per risk?
Yeah, so one of the, I think, under sold or spoken about items was that as the larger specialty carriers were pulling back from $50, even $25 million limits to tens and fives, the insurance need was still the same. So the broker had to work that much harder to fill it. And so there's no doubt that number of carriers coming in is somewhat responsive to, I used to be able to fill this with 6 carriers. I now need 11. And so we need some new space. I think that's largely worked itself out. You tell me, you're closer to it than me, but that's what it feels like to me. It's whether or not the new carriers start to lean into, well, I was on 5 last year. How about I write you 15 this year? That's where I think it will be disappointing if that happens.
Yeah, I guess the one thing I would add there is that it's very easy for new capacity to jump into excess capacity.
Yes.
There's not a lot of barrier to entry there, and I think one of the places where we're able to see, whether it's us or competitors, continue to see traction is, in the primary product, and so I don't see that, abating.
Right. Well, here's an area where if we do a little commercial on ourselves here, being an SME focused company is helpful too. You just the rails of reasonableness between high and low bands of pricing tends to be a little less wild in the swing area, and as long as everybody's thinking about it reasonably and economically, and we assess risk the right way, there's just a little bit more. There's just a little more rationality to it.
So what's the next place that you think there's going to be, that you're going to see pain in the market?
Yeah. Well, there's 2 things that I'm thinking about that we're looking at. One is clearly there's been a lot of disruption broadly across the specialty classes, working with healthcare, and whether it's hospital medical malpractice or long-term care or managed care. There's been meaningful losses there, and as a result, some major carriers have made adjustments or left the market altogether. That, I think, is an area that's going to work itself out over the next few years. I think that'll take some time in that regard. And I would say also that commercial auto is an area that I would be continue to be focused on as an area where I think we could get, if we're going to see severity spikes and loss cost inflation, whether through jury verdict or other settlement, that would be an area where I think you'd have to focus.
Yeah, the other one that I guess I would bring up is the cyberspace.
Yeah.
And, certainly we've seen headlines in terms of price in cyber, and, certainly there have been headlines around ransomware. I'm not sure if the industry has gotten the coverage right.
Well, this is where I should probably be asking you questions, because you were a leader in this business in the early days. But I have to wonder whether or not ransomware can be an insurable risk on an unlimited basis. I think he can take some tranches, but it's an area where, from an underwriting perspective and a technology perspective, this is big business for second and third world countries trying to disrupt the world, and that seems to be a tough risk to get your arms around.
It is, and not to mention anything about some of the aggregation issues that some organizations may have around things like business interruption, dependent business interruption.
Right. Don't you think reinsurance does a better job than that, than insurance?
Well, I do, because you could, there you could have limitations on reinstatements. As a primary carrier, maybe not.
Yeah.
And so I think that's where you're going to have you could have potentially some issues depending on the coverage that's extended.
Yeah. Yeah. Good point.
So one of the next things I wanted to talk about is distribution in the specialty lines.
Sure.
Continue to see significant broker consolidation in both the retail and the wholesale channels. How concerned are you about downstream implications on carriers?
Look, we're a relatively small, mid-sized company in the insurance carrier side. Whether or not we were asked, I would ask this question 5 years ago or today, we have to be focused on the same thing. Let me back up and say it this way. It's always funny that when you talk to a carrier person, they think about distribution as an outsourced responsibility. It's theirs within their value chain, and we outsource it to our broker partners. And if you have a broker perspective, they've become thoughtful about that as risk placement or capital providing, almost as an outsource of how they think of the value proposition. So that push-pull is always there. I think in both cases, how you make a difference, even if the brokers of the world, wholesalers or retailers, get significantly larger than the risk side, you have to just offer something differentiated. And for us, it's expertise in a certain segment of the marketplace. It's responsiveness. We try to pick up the phone quickly and get back. And we understand that the quick no is the second best answer for the broker, and we try to stay focused on that. And I think if we do that and we make sure that we don't rely on just going to the corporate office as opposed to visiting the 15 important offices at one of the large, in our case, wholesalers,
Right.
then I think we'll be fine. I think we'll be fine, because it is ultimately a people business. And if we build those relationships and we are responsive to individuals, they'll work with us again.
Yeah. One of the things you talked about earlier was about the focus in SME business, and many of the brokers in the SME space can tend to be independents. How do those firms or those people survive in this type of consolidation environment?
Yeah, it's a similar answer in that I do think if you've ever owned a small business, you recognize that your insurance purchasing decision may be an hour allocated per year of time or two. Whereas those of us who live in the insurance world, we might think about it. We think about it all the time, and we therefore presume that the other end of the transaction is thinking about the same way. It's just one. It's not an unimportant decision. I think it's very important, but it's just one of thousands of important decisions that a small business owner has to make. So how do they do that? They look for a trusted advisor in that particular case, who they know, who brings value and understands what the risk is, both actual and emerging. They have to be forward-seeking. Used to be, if you had a good carrier placement and the strong ability to pick up a lunch check, that would be enough to be a successful distribution person. That's long not been the case. I think as a small business person, as an independent wholesaler, you've got to stay focused on that too. And
Yeah.
and I think that's how they differentiate. And it's not really different than us as a smaller carrier.
No, it's not. As long as someone's going to be bringing you good service and value,
Right.
that's going to be good enough.
Yeah.
The insurtechs.
Yeah.
So particularly in the underwriting segment has been a much discussed topic, and we see them in the MGA space. We see them some in the carrier space. We see some carriers referring to themselves as insurtechs.
Sure.
Are these
just like some carriers refer themselves as specialty?
That's true.
Right.
Or technology companies. So
Yeah.
are most of these just are these just a premium grab with more of a marketing focus rather than underwriting?
Well, there's a whole cross section, right? Technology has been disruptive and will continue to be for ours and every industry. The ones that are largely focused on mass market capacity, almost mandatory buys, personal lines, homeowners, auto, et cetera, often have a revenue focus as opposed to a profitability focus. That the presumption is if I get the revenue, maybe I can figure out the underwriting later. We've seen different versions of this before. Maybe a good example would be hedge fund reinsurers, which saw the ability to put a reinsurance company offshore as a good vehicle to build investments. But they forgot that it's not a fine tuning dial on risk, and that you really need to spend time on that as well. I think that's going to be true for some of these insurtechs. But there are some really meaningful insurtech businesses within that umbrella category that will help drive differentiation. For me, if there's access to data where you can maybe create differentiated underwriting viewpoints that are to date not market norm, I think is interesting. And the same thing on the claims side from an adjudication perspective. And I do think there's a lot of that coming as well. And I think that's value driving over time.
One of the things that we've the things we talked about here, we talked about rising rates, we talked about consolidation, distribution. When you look at our competitors, or you look out at the way people are viewing the market, where do you think people are getting it wrong?
I think that insurance is a good question. I think insurance is actually an extraordinarily complex business that has a lot of factors in it, right? There's the ultimate cost of losses is something that we say all the time that you don't know when you price the product, but you make an assessment on the likelihood of a loss, less time on the likelihood of that loss happening at a period of time when the costs to settle that loss are different, or whether there is another macro event or like a pandemic or other black swan event. And I think often we have a tendency to maybe simplify it down to one thing, right? So rate, where we started our conversation today. Rates going up, not because of altruism, because there's losses. And there are other things happening as well. Language is tightening, and limits are being reduced, and reinsurance is being restructured, and expenses are being carved to be more efficient, and technology is driving those component pieces of it. If you're trying to grab revenue, it's a macro bet, and that may be the right bet today, and it may be the right bet a year from now. But you put risk on your books for a long period of time, even if it's claims made, and if it's occurrence, a really long period of time. And that's something that I think oftentimes the people in this industry don't see. It's why I think the first generation of insurtechs were about disrupting or destroying the insurance industry. But if you look at the ones today, they're much more about partnering with the insurance industry because they really understand the risk part of it. So that's where I think people need to be wary.
Are there any insurtechs that you're particularly interested in, focused in, or is it just you're just interested in some of the particular trends?
Well, it's really more the trends. I won't call anybody out, not like I'm moving any needles valuation wise anyway, but you know, I'm interested in things. You talked about the differentiated underwriting stuff. I'll give an example of something I remember dealing with some years back. I love the idea of personality scores for bedside manner as a predictor of medical malpractice claims for doctors. We don't write doctors, so we're not, right now, so we're not doing it. But I give that as an example of something where that's a differentiated outcome that I can tell you the market to this day, and I remember talking about this 10 years ago, still isn't really doing. And I think there's opportunity like that out there as we get better and better access to data.
Great. Well, hey, Jack, I appreciate you taking the time on the webinar, and thank you to everyone who called in. We'll have it available in a couple of days up on our site. So thanks a lot.